So joining us now is Ed Modla from the Options Industry Council. Now, Ed, we've had the opportunity to meet numerous times as you often come up to Canada for the Options Education Days, and we've had a chance to catch up. But thanks for coming on to the show, first of all.
Well, it's a pleasure being here. Thanks for the invite. It's always nice to see you in person, and I'm really happy to be here with you and Kevin to talk a little bit about options today.
I'm excited about that too. Now you put together a little slide deck. I thought for the first part it would be a great thing to just talk some option strategies, and so you
Yeah.
prepped a few of them. So there's two strategies that you wanted to talk about, but we want to deconstruct this. So the first one wanted to talk about was the covered combo, correct?
Yeah, that's right. And so to overview that, the two strategies I selected are strategies that I teach quite a bit when I'm out on the road or doing online presentations. And really, there's nothing too complicated about them. They're rather simple, but oftentimes, even when I speak to money managers and professionals, they seem enlightened and haven't thought of doing quite the type of construction that I'm going to walk through. And it really showcases the versatility of the product. That's what I like about these strategies.
All right. So let's dive into it then. And so we're going to talk about this covered combo, right? And so it's broken
Yeah,
down.
sure.
So it starts with the covered call, right?
It does, yeah. So, like you said, we're going to deconstruct this a bit, and eventually we'll put together the covered combination, which is also called the covered strangle in its entirety. But to look at it from a more simplistic perspective, you take the pieces apart, and that's what you're doing here. The covered call is the first step to that. Of course, the covered call has two pieces to it. You own 100 shares of stock, and in our case, you own shares at 52. And the reason why you do a covered call is to get the option premium. Whenever you sell a call or a put, no matter what strategy it is, the motivation to sell options is to capture the premium, get the time value there, and enhance your likelihood of success. I always say to people, whenever you improve your break-even points, just remember you're improving the odds that you're going to be profitable on a trade. That's exactly what you're doing here. So you're moving your break-even point from that stock entry down a little bit by the amount of the option premium of 175, and now you've got a better break-even point and a better chance of success. That's pretty simple, straightforward. Now things
Yeah.
can get a little interesting with the covered call as a stock moves down, as a stock moves up. There's different things you can do and things you need to track versus intrinsic and time value to manage the position. But at the crux of it, guys, that's really what it is.
So Ed, just for our listeners that are not familiar with this, when we sell a covered call, you are
Mm-hmm.
undertaking a contract that obligates you at a higher price, often in a profitable position, to be obligated to potentially have to sell your stock away. Or you could be called
Yeah.
away on your stock, but often you're doing so in a profitable position. So you've kind of capped your upside, but you were paid a premium upfront for doing that, right?
Yeah, that's exactly right. And as you said, usually you do have a profitable position that you're trying to unwind, and you're sort of using that call option as a limit order somewhat. Now, it's not exactly like a limit order because your shares probably won't get called away until expiration. So you got a little risk there that the stock can go up and drop back down. But by and large, you're exactly right. You sell an option, you're obligated to sell shares at a price you wanted to anyway.
Right. And so now now this combination has you basically double down on this with a secured put, right?
It does, right, and that's the way it's taught, and we're going to do that today. I guess we'll get to the next slide or so in a minute here. What I like to teach it in a way that showcases the covered combo as a way to reduce your risk even beyond what the covered call has. But here's the other side to it. As we said, we're building this. Here's the cash secured put side. This one's very simple, just one trade, selling a put. We see the 45 strike put, sell it for $2. Stock's trading higher than that. And in this case, maybe you think the stock's going to drop. You want to pick up some shares at a lower price, so you sell a strike price you're willing to pay for the shares at. That's your obligation to buy shares there at 45. In the meantime, if the stock sort of lingers or consolidates around its current level, or if you're completely wrong and the stock really doesn't pull back at all, because that's usually the motivation here on this trade. If the stock just rallies straight up, you keep the option premium. So similarly, you're using a limit order, an alternative to a limit order to buy shares, and doing so through the form of selling a put option and taking on the obligation there at the strike price.
That's right. And so the idea here in this is that you basically have yourself a covered call, and at the same time you collect some premium for the selling and put at a lower strike, and you're basically
Yeah.
you're like a cash flow pig, right? You're just like grabbing
Yeah.
all this cash off there, lowering your cost base, and basically putting yourself in a better situation, even if the stock was to stay the same in price, right?
Yeah, you're doing all of that, and this is where it really gets interesting. So you're combining or merging covered call, cash secured put, although you're not increasing the number of shares. So you see 100 shares, you're long, but instead of just selling calls or selling puts, you're doing both here, enhancing the income generation, lowering your break even points even further. And yeah, as you mentioned earlier, you're potentially doubling up on the amount of shares that you own because the 60 put that you sold might obligate you to buy more shares if the stock does drop there. The tweak that I put on this presentation every time I give it is that, oftentimes investors are not dealing in 100 share lots and one option at a time. They might find themselves with 500 shares or 1,000 shares. And then, so that's where I make the comparison. If you look at the covered call position, long 1,000 shares and short 10 calls, and compare that to a sized down covered combo where maybe you have 500 shares and you sell 5 calls up top and sell 5 puts down below. If you're assigned, all you're doing is going to a full size position. That sized down combo actually has less risk than the covered call position would have. It also has less reward because of the lower share count, but you're going more conservative than the covered call position, and that's what a lot of investors find enlightening about this covered combo. And then take it from there. Sell as many calls as you want on the upside. If you own 500 shares, maybe you sell 3 at a certain strike, 2 at another. Maybe you don't even sell all 5. Same thing on the put side. You can stagger your strikes and do different things. Really opens up a lot of doors and showcases that flexibility of the options product.
Now, I personally love this idea, so long as you're doing it on a Johnson and Johnson. But pulling this stunt off and on a Chesapeake Energy it would be a challenging trade. Like so, I guess what underlying you're choosing is really important, right? Is because
Yeah, for sure.
you have to be prepared to actually own the stock and have the underlying. Uh, you might have it put to you as it's going lower, and you're going to a
Yeah.
situation where you're taking on that downside risk. So you have to almost you have to have a basket of stocks that you feel are like rock solid, almost like you have to choose the best of Warren Buffett's stocks, and not
Yeah.
Kraft though.
Yeah.
But
It's an excellent point. Yeah, when you're going to implement a strategy like any other, you do have to be a bit selective on the type of names that you're going to be using it on. But sometimes this is going to work. Like you said, it's a great approach, and you're just putting things in your toolbox as you're trading and using options. You want to pull out the right tool at the right time. This is one of those choices. And the other thing about this strategy is, as you're looking at it, is we're still selling the same amount of options we would if we were doing either of the two previous strategies. But in this case, again, comparing it to covered calls, which is really a popular strategy, when you're selling calls and puts on both sides of the underlying, it's very likely you're going to get actually more option premium for the 10 options you've sold here versus the 10 calls because of the volatility skew and the expectation that the puts are going to have a little more juice and premium than the calls would. So still selling 10 options, maybe even more premium. Like you said, not for every trade, for every symbol out there, but certainly something you can use on occasion.
A situation where I could see this being really interesting is, let's say an investor knows that they're going to have a big inflow of cash into their investment portfolio, let's say 3 or 6 months forward, but they themselves today don't have that money there. So their portfolio is only at half size, and it's gonna be much bigger later. Well, when you sell those puts, and let's say you sell them out those 4 or 6 months out in the strategy, it is using margin to carry it, but you're not soaking up big margin interest in being in that situation. Anyway, so there's tactical times where I could see this coming in
Yeah.
handy.
And can I just pop in here? It's Kev. So to me, it looks
Yeah.
like this strategy works best in an environment where the market is overpricing the forward expected volatility of the underlying instrument. Would you agree?
For sure. I would absolutely agree with that. Of course, we're selling options to forecast that and take advantage of that. And certainly, as a good point that was made by Patrick there, if you're forecasting out the potential for more capital coming into your account, but not quite yet, then selling puts and downsizing on the share size and the share count might be a good way to get that started.
Right.
All right. So now you have a second strategy you wanted to quickly share with us here, and this one's
Yeah.
the bullish three-way. And so,
hmm
Which
what's
is what we always wanted to do in college, but you never got a chance.
Oh man, how many? Never got a chance. Well, that sucks. So yeah, this is great, and
Ed, you must have
again,
lived a better college life than I did, buddy. If you were
I'm
in the
still
bullish
trying.
two-ways.
Let's just put it that way. I'm still doing my best, but so yeah, guys, this is another strategy. I'll say similar to before, where you're really not doing anything too complicated. You're just putting simple strategies together, and then the end result is just far different than what you start with. Now, the dominating factor here is your directional to begin with. You're bullish, or maybe you're bearish. In this case, we're bullish, and buying a call option, of course, is an alternative there. You want to capture the upside, have long deltas, and have the potential to gain on the upside that's unlimited, and that's what calls do for you. And that's why I started with that. And you see the risk profile is pretty straightforward on what a long call is. You make money as the stock starts to go up, and of course above your strike price. Now, if you keep going with that, and you add on, if you click one more time, you should get the three-way to pop up there. You see, what I'm doing here is really simple. So you still have the calls. Again, that's the driving force behind the trade, buying the 110 calls for $4.30. But instead of just doing that, go down below where the stock's trading right now and really doing a couple of things. So you're doing a bull put spread, you're doing two bullish trades, combining them together. One's an outright call, one's a bull put spread. Of course, that's going to entail more risk. But what you're doing here, the huge benefit, really two of them, is greatly reducing your break-even point. You can see where that is on the charts. At expiration, the break-even point for buying the calls is way up there near 115. It'll be around 114.30. On the three-way, all the way down underneath your put strike, where at the level where you'd be giving back your net credit, if you can do this for a net credit. So about 99.5 would be your break-even point. So greatly reducing that. But then the highlight benefit of doing this is you own a call option, you reap all the benefits of that call option if you're right on the directional of the move, and you have no time decay. You've taken theta risk off the table with this three-way. What happens is, on the other side, what do you give up? All that downside potential loss. Of course, the width of your put spread is going to be your loss. If you're completely wrong and the stock does move against you, then yeah, your risk is greater, but you get those benefits on the upside. Probably more suited to a longer term trade with an uncertain time horizon on when the stock's going to move higher. Maybe that's more geared towards fundamental analysts, but again, putting tools in your toolbox and doing something different here, owning an option, but not having to worry about time decay, and that's what I like about this strategy.
Yeah, so to me this is interesting because the one enemy of someone who's just long options outright is always going to be the fact that if the stock is just doing nothing, like exactly what the stock market has done for the last 2 weeks, it's just chop, chop,
Mm-hmm.
chop. Unless you had Disney or something in your portfolio that's popped, most of the stocks have just been muddling along, and you're just theta burning throughout that entire period if you're long a bunch of call options. And so at least with this strategy, if the stock is stuck in a range, you've been able to offset it. I mean, yes, you do have that downside risk if it goes against you, but if the stocks are staying the same, it's not costing you a lot. So yeah, and I like it. I actually have done this, but I've actually done the reciprocal. Where I basically am buying put options to the downside and doing my call spread, the credit on the upper end to create almost the reciprocal to the short side. And I like that because often the option skew makes the call options actually cheaper out of the money. And so you can actually really buy that out of the money hedge within the spread for really cheap. And so you can kind of create a really nice trade when you're bearish and create that nice offset, right?
Yes, certainly. And as you pointed out, going in the opposite direction, very viable if you want to hedge the portfolio in some way to get downside exposure, or if you are bearish on a particular name, then doing the reciprocal works very well. And you pointed out something very important there, watching the skew and knowing where that is, what volatility levels are trading at. And when you're buying and selling options, just keep an eye out for what you're buying, what you're selling, and how pricey those options are.
All right. Well, listen, Ed, you're going to join us here for the after hours, and we're going to have a great chat. But before we let you go in this segment, why don't you let people know where they can find you and get more information on options if they're interested in learning?
Mm-hmm. Yeah, great. Well, thank you for that opportunity. We are funded by the Options Clearing Corporation. So the website is www.theocc.com. There's an education tab on that website that'll take you over to the Options Industry Council, and there you'll find a wealth of information. I'm doing a lot of presentations online and on the road. If you want to go to the events section, you can check out what's upcoming in the near future. Sign up, register. We're doing webinars every month. That we get external exchange presenters to do, industry personnel, or in-house talent that presents those. So check out the website, see what we have upcoming, and also have contact information up there. If you want to send us an email, you can contact our investor services team. They'll answer any questions you got about options or about what we have to offer.
All right. Well, thanks a lot, Ed. All right. So, and those of our listeners that want more from Ed and hear some great stories, stick around for the after hours at the end of the show.